See, his super senior CDO shorts were built on the same toxic mortgages he was betting against. He thought he was insulated, but he wasn't. When the housing prices finally started to fall, the defaults just surged. Suddenly, all those supposedly uncorrelated assets started moving in lockstep. The correlations exploded. The diversification that was supposed to protect everyone, it just vanished into thin air. The complex mathematical models the entire system was built on had assumed this scenario was impossible. But reality, as it often does, disagreed. Let's get into the numbers that nearly killed one of the world's biggest banks. Hubler's short position, his bet against the housing market, made about $2 billion. A massive win, right? But the insurance he sold, that free money from the super senior tranches, carried nearly $15 billion in exposure. As the market imploded and losses mounted, the margin calls started flooding in. Risk limits were breached left and right. Up in the executive suites, people started to panic. The final result? Staggering net loss of around $9 billion. It remains one of the largest single trading losses ever recorded in history. Morgan Stanley as a company survived, but it was permanently weakened, a shadow of its former self, all because of one trader's perfect trade. And here's where the story gets a truly ironic twist. You've probably heard of Steve Eisman, one of the main characters from The Big Short. He was the loudest, most aggressive critic of the housing bubble. He was making a fortune betting against the very system that Hubler was a part of. But here's the catch. Eisman's hedge fund was owned by, you guessed it, Morgan Stanley. For a terrifying moment, Eisman's fund almost collapsed. Not because his thesis was wrong, he was dead right, but because the bank that was backing him was on the verge of going under because of Hubler's trade. The system was literally eating itself from the inside out. So, what's the real lesson here? Howard Hubler wasn't stupid. He wasn't a fool. In fact, he was almost right. And in the world of high finance, being almost right can be fatal. The true takeaway from the 2008 crisis isn't just about making bad predictions. It's about the dangers of hidden leverage, the false sense of safety we get from complex systems, and the catastrophic error of trusting models over reality. The next crisis won't come from the thing that everyone is watching. It'll come from the blind spot, the thing everyone thinks is impossible. If you want the next chapter in this saga, the story of synthetic CDOs, Eisman versus Miller, and what happened to the real villains of The Big Short, make sure you subscribe, because this story is far from over. Thanks for watching.